Good day, inderesTV viewers and listeners. Sampo published its first quarter results. Today I'm interviewing Group CFO Knut Arne Alsaker. Knut, another good quarter for Sampo. What were the highlights shareholders should be aware of?
Well, first, good to have you here again. It's another quarter, a good quarter, starting with the top line, which was really good with a 10% premium growth. Coming from business area private, the largest business area, which grew by more than 7%, despite the fact that we had another quarter of modest new car sales. We grew more than 14% in personal insurance and more than 7% in property. Two of the areas where we have growth ambitions, which we talked about at the Capital Markets Day. Also highlight the good 1/1 renewal. During the first quarter, about 40% of our commercial industrial risks renew, and a lot of them at 1st of January. And we had another renewal where we got the rate actions that we plan to make through. Also, not least, our UK segment Hastings, which had a premium growth of 25% compared to first quarter last year. So really good growth momentum. Then that is growth with profitable margins. Our underlying margins improved by a bit more than 1% on a group level, and that's adjusting for some of the volatile items. For example, weather. We had a winter in the Nordics, not in the UK, but in the Nordics, which was the harshest winter since 2010. And as a group, that cost us 120 million euros. So that is, it's not exceptional because these winters happen from time to time, but not that often. The last time we had a similar weather with both lots of snow and long periods of freezing temperatures was back in 2010. Then, of course, we continue to have a strong balance sheet, also related to the partial internal model that we just recently got approved, and which you might come back to. But good growth and growing at the same good margins, which we sort of planned for and talked about at the CMD. Maybe just one little detail talking about margins and profit growth in the UK. We have an operational ambition for the next 3 years to grow underwriting result by between 10 to 15% in the UK. First quarter this year versus first quarter last year saw a growth in the underwriting profit of 70%. So really good start of the year there.
A few follow-up questions. First about those renewals. If I recall correctly, you did quite large price hikes there. So is it easy to get those through to your customers? The renewal rate was high in any case.
One renewals, which again is primarily for the corporate lines. It's a market which requires rate hikes. We've been doing that for some period of time now, and that's in particular in the large corporate lines that follows also the reinsurance market, which have seen a similar direction of travel lately. And of course, for those lines, it's also where we buy most of our reinsurance. So we also have to take that into account when pricing our customer risk, and we do. And the 1/1 renewal came in line with also the reinsurance pricing, which means that we pushed through those price increases from the insurance we buy for our balance sheet through to our customers on the direct side.
Exactly. If we talk about If's growth in the Nordics in general, can you elaborate about the mix? How much was about price hikes and how much about maybe taking market share from others?
Yeah. We have an inflation which is in the Nordics between 4 to 5%. The higher end for motor and somewhat lower for property. So that we obviously need to price for, which means that is a larger part of the total premium growth. But we also take some market shares. Where the last market share statistics, they come a bit different times in different countries, but show a positive development for us, not least in property, which I alluded to was a part which also contributed to the private growth in the first quarter.
I could ask another question about the Nordic markets. That usually we talk about one Nordic market, but from Sampo's perspective, are there differences between Nordic countries when you think about profitability or your market share or competitive situation? Is it just the one Nordic market or separate countries?
No, in many ways, it's one Nordic market because the markets have similar characteristics. For retail, private business, it's dominated by local players or Nordic competitors. Versus on the industrial lines, there's also a presence of international competition, but the companies that compete and operate in the Nordic markets are mainly Nordics. Some of them have businesses in more than one countries, but many are also so local in either Norway or Finland and sort of stick to their domestic market. Products are similar. Not identical, but similar, and similar enough for us to be able to produce our product in one production system. We obviously need to make some tweaks, local adaptations, and of course languages are different, which we know, but it's similar enough to be able to have one production system and takes the benefit and synergies out of doing so. Then, of course, claims in the markets, they vary from quarter to quarter and year to year. Let me take the winter claims as an example, where the majority of the winter, the most severe winter was in Norway, less in Finland and in Denmark. And these things happen from time to time, which means that within countries and business areas, and if you go even deeper to that, a business area in a country and a specific line of product, you will have more volatility and similar sort of combined ratios quarter for quarter. But for us, being a pan-Nordic players with large operations in all markets, that also create a significant diversification effect, which is a benefit for us, of course, and our shareholders. If I take one other thing, which is important for us and for Nordic insurers and Nordic insurance markets, is that all markets, although at similar or at different pace, is more and more about doing business digital, both in terms of the purchase process, the administration of your products, and also claims handling. And we made significant investments in digital and consider ourselves to be sort of a digital insurance market leader in our markets. And there are some differences where we are today. Finland has been a front runner. Maybe in the other end, we have Denmark, but all markets move in the same direction. So also in terms of distribution, markets become over time more similar.
So Nordic markets are same but different, as they say.
Same but different, and different for us in a good way, because that means that we have these diversification effects where we can sort of, with our large scale, being present in all markets, in so many different products, in all customer segments, we can smooth out local volatility over time by having good results in other markets or other business areas.
Exactly. since we do these interviews regularly, I think there will come a point when we chat about the weather, and this is a good point for that because we have another harsh winter behind us, and it seems that those volatile weather conditions, they just turn more extreme every year because of the climate change. So how do you see in the long term that how does climate change affect your risk management and interest pricing in the Nordics?
Yeah, before I address the winter, I mean, we as a group, just on climate change, we have committed to the Science-Based Target Initiative to basically contribute to make global warming not exceed 1.5 degrees Celsius, which is important for us to make a contribution to that initiative from the Paris Agreement back in 2015. So from that perspective, we absolutely take climate also seriously. When it comes to the winter and what we have experienced lately in terms of weather events in our markets, I wouldn't call it extraordinary. Like I said, for the winter in Q1, we've had a similar winter before. And then we've had many winters in between, which have been less severe and very normal. So when it comes to weather, not least in the very northern countries where we operate, I mean, it is a part of our normal business, really. That also goes for cloudburst in the summer or what have you. Then, of course, all risks that impact our claims, we monitor and analyze on a sort of continuous basis and make price adjustments if needed. And it's important to remember for our products that we can do a repricing of our products if needed every year. So we don't sort of need to think today about what winter we will have in 2060. But we do also take that seriously in terms of our commitment to the Science-Based Target Initiative, which I mentioned. But there's nothing in the last few quarters and weather events which have made us see a need to significantly reprice the weather risks that we have experienced.
Exactly. Then the last one. You received approval from the Swedish Financial Supervisory Authority for the, I have to check my notes, implementation of a partial internal model. What does this practically mean, and why should a shareholder be interested in this?
Yeah, I started in the insurance industry when we had Solvency I, which was extremely simple. Then came Solvency II, which is quite complex, and I will be retired when Solvency III comes. That is for sure. But what this means there in Solvency II, it's a fairly complex way, but reasonable way of calculating all kind of risks and put capital aside on your balance sheet in case these risks should materialize. And under the Solvency II regulations, there's, put it simply, two ways of doing this. You can either have what is called a standard formula, which has a lot of rules and regulations, but preset, which is meant for an average insurer. And there is no such thing as an average insurer. So if you use the standard model, you get something wrong. For us, one of the things which the standard formula doesn't get right for us is the calculation of our insurance risks, premium reserve risk, particularly related to what I talked about, the diversification effects we have by being a large player in the markets that we operate, and the fact that these claims patterns and risk doesn't fully correlate. And this partial internal model, which then is our model, developed over decades, calculate these risks much better for Sampo. That same model wouldn't be applicable for another insurer in another market, but for Sampo, it's a much better model and a correct model of calculating these risks. And what the result, that the outcome of this process is that our capital requirement drops because the risks that the standard formula calculates, which doesn't take into these diversification effects, doesn't take them into account, calculate too high of a capital requirement for Sampo. And by implementing the partial internal model, this model for these type of risks I mentioned, now during Q2, our solvency capital requirement will drop by 300 million euros. And that was an outcome of this process, which was exactly in line with the expectations that we talked about at the CMD, which means that the effect from the reduced solvency capital requirement and the change we did in our solvency capital management framework at the CMD generates in total 700 million euros of deployable capital. And this is completely new, just came the other day, and we will calculate the solvency capital requirement according to this model for the first time now in Q2, which means that we will come back and talk about the deployment of those 700 million euros in connection with our half-year result in the beginning of August. And the discipline that we also talked about at the CMD, we haven't changed our view on that.
Thanks, that clarified a lot. I'm looking forward for the deployment of that capital. Thanks, Knut, for the interview.
All right, thank you. Good to see you again.